Every day, millions of people look at the exact same screen, staring at the exact same blinking green and red numbers. But they are seeing two completely different worlds. To one group, these numbers are a chaotic, hyper-fast game of psychological warfare, where a split-second delay can cost a fortune. To the other, these numbers are just the slow, boring heartbeat of global commerce. This is the invisible divide between trading and investing. It's not just a difference in timeline. It's a completely different philosophy on how wealth is created, and more importantly, a battle over how much control we actually have over the future. Let's start with trading. In the modern financial narrative, the trader is often romanticized. The lone wolf beating the market from a laptop. But stripped of the hype, trading is essentially an extraction business. A trader doesn't care about the underlying company. They don't care if a business makes a revolutionary product or a terrible one. They only care about one thing: price action. To a trader, volatility is oxygen. They survive on the friction caused by human emotion, fear, greed, and overreaction. They use complex mathematical setups, technical indicators, and order flow to guess where the herd will move next. Trading operates on a compressed timeline where math often collides with pure chaos. It is a zero-sum game. For every trader who successfully catches a breakout, someone else on the other side of that digital ledger just lost. It's a high-stakes discipline wrapped in the illusion of absolute control. Then, there is the investor. If trading is a sprint through a thunderstorm, investing is watching trees grow. Investors don't view the stock market as a casino or a video game. They view it for what it was originally designed to be: a marketplace to buy a piece of an actual, living business. When you invest, your edge isn't speed or technical analysis. Your edge is time. An investor accepts that the market is irrational in the short term. They know that tomorrow, or next week, a tweet or a bad macro report could send their portfolio down by 10%. But they are betting on a foundational truth of capitalism, that over a long enough horizon, productive companies will generate earnings, expand their moats, and create real economic value. The investor trades the adrenaline of today for the compounding interest of tomorrow. So, which path is correct? The answer lies in understanding the hidden tax each one levies on your life. Trading demands active execution. It taxes your attention, your cognitive load, and your nervous system. You are fighting against institutional algorithms and high-frequency firms. The barrier to entry is low, but the barrier to survival is incredibly high. Investing, on the other hand, demands passive endurance. Its tax is emotional. It forces you to sit perfectly still while the media tells you the world is ending. It requires you to do the hardest thing in modern finance: absolutely nothing. Ultimately, the market accommodates both. The traders provide the liquidity that allows the investors to buy and sell with ease. But before you place your next capital allocation, you have to ask yourself a fundamental question. Are you trying to outsmart the clock, or are you willing to let the clock do the work for you? Because in the end, the market always collects its due.